The S-Corp is the most requested topic I get, and it's also the most misunderstood. You've seen the clips. Save 15% on your taxes with this one election. What those clips leave out is the payroll you're now required to run, the separate corporate tax return, and the administrative costs that eat into whatever savings you thought you were getting. An S corporation is not a type of business you form. You don't go to the Secretary of State and ask for one. An S corp is a tax election. It changes how the IRS treats your income, but it also changes what you're responsible for. And whether it actually saves you money depends entirely on your numbers, not on a general rule. Today, we're covering two things. First, what the S corp election is and how it works mechanically. Second, the break even math that tells you whether it's worth it for your specific business. Welcome back. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. I've seen S Corp elections save business owners real money. I've also seen them create compliance problems that cost more than the taxes the owner was trying to avoid. The difference isn't the election itself, it's whether the business was ready for what comes with it. This is where we slow down. We're going to spend 3 episodes on the S Corp because it deserves the level of attention. We're going to spend 3 episodes on the S Corp because it deserves that level of attention. Let's clear up the biggest misconception first. You don't form an S Corp. When you go to your state, you form an LLC or a corporation. Those are legal entities created under state law. An S Corp is a federal tax election. It's a decision you make with the IRS about how your income should be taxed. What you're doing is telling the IRS, I have an LLC or a corporation, but I want to be taxed under Subchapter S of the Internal Revenue Code. The legal entity stays the same. What changes is the tax treatment. The form that makes this happen is Form 2553. It also has to be signed by all shareholders and filed within a specific window, generally within 75 days of the start of the tax year. Miss that deadline, and unless you qualify for late election relief, you're waiting until the following year. Once the election is in place, here's what changes on the tax side. As a disregarded LLC, your business activity lived on Schedule C. As an S Corp, your business now files its own separate tax return, Form 1120S. This is a corporate return with its own balance sheet, its own income statement, and its own filing deadline, typically March 15th. After the 1120S is filed, the business issues you a Schedule K1 reporting your share of the corporation's income. You take that K1 and report it on your personal 1040. The business itself generally doesn't pay federal income tax. The income passes through to you, but the way that income is categorized changes, and that categorization is what drives the potential savings. To understand the S Corp math, you have to understand what changes about how your income is taxed. As a sole proprietor or a disregarded LLC, you pay self-employment tax on your entire net profit. If your business clears $100,000, the full $100,000 is subject to 15.3%. When you elect S Corp status, you become an employee of your own corporation. You pay yourself salary through payroll, and the remaining profit is distributed to you as the shareholder. The salary is subject to payroll taxes. The distributions are not. That's where the potential savings come from. You're reducing the amount of income subject to that 15.3% by splitting your total profit between salary and distributions. If your net profit is $100,000 and you pay yourself a salary of $50,000, the other $50,000 comes to you as a distribution. You've reduced the amount subject to payroll taxes by $50,000. At 15.3%, that's a potential reduction of roughly $7,650. That number sounds significant, but that's the gross savings. The net savings depends on what it costs to operate the S Corp. Here's what the S Corp adds to your annual overhead. The corporate tax return, substantially more complex than a Schedule C, higher preparation cost. Payroll processing, a payroll service with monthly or per pay period fees, plus the time to manage it. Employer-side payroll taxes. The S Corp pays the employer half of Social Security and Medicare on your salary, plus federal and state unemployment taxes. Additional bookkeeping complexity. Salary, payroll tax, liabilities, distributions, shareholder basis, corporate level transactions. For most small S Corps, the total additional overhead runs somewhere in the range of $3,000 to $5,000 a year. Go back to that $7,650 in gross tax savings. Subtract $3,000 to $5,000 in additional cost. Your net savings might be $2,000 to $4,000. That could be worth it. But if your profit is lower and the savings are smaller, the cost might eat the entire benefit. That's the break-even analysis. If the tax savings don't meaningfully exceed the cost, the election isn't serving you financially. There's another factor the break-even math has to account for: consistency. The administrative costs of an S-Corp are relatively fixed. You're paying for the return preparation, the payroll service, and the employer taxes regardless of how your year goes. If your profit drops, those costs don't drop with it. The tax savings are directly tied to your profit level. Lower profit means a smaller distribution, which means less income shielded from payroll taxes. If your profit drops enough, the savings disappear entirely while the costs stay. This is why I emphasize consistent, predictable profit when evaluating S-Corp readiness. One good year isn't enough to justify the election. You need to be confident that your profit level will sustain the math over multiple years. Now let's talk about the IRS side. The S-Corp election doesn't just change your taxes, it changes how the IRS looks at you. The core risk area with S-Corps is reasonable compensation, the salary you pay yourself. The IRS expects it to be reasonable for the work you perform. If your S-Corp generates $200,000 in profit and you're paying yourself a salary of $20,000, that gap is going to draw attention. The IRS has industry data. They know what people in your position typically earn, and if your salary is significantly below that range, the IRS can reclassify distributions as wages, assess payroll taxes that should have been paid, and add penalties and interest. When I was at the IRS, officer compensation on S-Corp returns was a consistent focus area. We're dedicating the entire next episode to reasonable compensation because getting that number right is what makes the entire structure work. Here's the bottom line. An S-Corp is worth considering when two conditions are met. First, your profit is high enough and consistent enough that the tax savings meaningfully exceed the administrative cost. Second, your bookkeeping and operational discipline are ready to support the requirements. If either condition isn't met, the election can wait. There's no penalty for staying on Schedule C while your business grows into the S-Corp. There is real cost to electing too early. Before next week, look at your last 12 months of net profit. Not revenue, net profit after expenses. Is that number high enough that the break-even math works? Is it consistent month to month? Next week, reasonable compensation. What it means, how it's evaluated, and how to determine your number without getting and how to what it means, how it's evaluated, and how to determine your number without creating risk. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.